So it's that time of year when all of the big banks and financial institutions issue their economic and market outlooks for 2021. I recently listened in on Charles Schwab's 2021 economic outlook and wanted to share with you some of the key highlights and questions on advisors' minds. Let's get into it. Hello once again and welcome to another video from One Up Financial. I am your host, Eric Persagna, here to help you increase income, reduce taxes, and invest smarter in retirement. In this video, I want to highlight 4 questions that were addressed in Charles Schwab's most recent 2021 market outlook. For the most part, they spent that call just kind of rehashing what happened in 2021, discussing some of the different areas of the market that performed well and didn't perform well. But they focused the majority of their video on questions from advisors, which I thought was great because oftentimes the questions from advisors come from the clients that they're meeting with, right? So what I wanted to do was kind of pick out the 4 questions that I thought were most relevant to the investors that I work with and some of the questions that I've heard from clients and prospects myself. So getting into it, question 1, what are your thoughts on potential tax increases coming and what does that mean for the market? So Schwab kind of went into this and talked a little bit about the potential for tax reform happening in 2021. And they really said it was likely a 2022 event. So even if something happens in 2022, likely it's not going to be retroactive, meaning there's probably not going to be too many changes in the way of tax reform in 2021. So now this is me speaking here, not Schwab. I think that even if nothing happens in 2021, this is a year that you're going to want to be doing tax planning. It's a year that you're going to want to know your tax situation and make sure that you're doing things now to plan for potential changes that could be coming in 2022. Because there's certain things that I've seen that are on the potential tax bill that could be enacted that might affect the deductions that you're taking now and that might affect how retirement contributions are treated in the future. So I think just because that tax reform is likely to be a 2022 event doesn't mean that you should just do nothing and forget about your tax situation and your tax plan for 2021. Second question that I thought was very relevant. How will COVID, stimulus packages, unwinding of debt affect the economy over the next 3 to 5 years? And how will we fare against other major economies? So I love when people ask questions that have like 7 different questions within the one question. I thought Schwab did a really good job with this one. They didn't necessarily answer every piece of that question, but they highlighted some really key components that I think people ought to be aware of and know about. And one of those was China. And despite the unknown of where COVID came from and the fact that it could be potentially from some factory or bat soup in China, the fact remains that China actually had positive GDP growth throughout the pandemic, and it really was a result of how they handled COVID-19 and how they react to viruses and diseases when they come about. So I thought that was actually interesting because I know a lot of people are very negative on China for good reasons, but when you look at their economy, they actually came out of this much better than most other economies around the world. Another key point that Schwab brought up was the IMF, the International Monetary Fund, which kind of tracks different economic statistics around the globe. And they projected right around a 5.5% to 6% growth in our economy for 2021 and another 4 to 4.5% in 2022. So I thought that was just reassuring to know that the organizations out there who are tracking all of this economic data and are planning for the next year or two really see our economy coming out of this pandemic really well over the next couple of years. So I thought that was a nice, reassuring piece of data that I wanted to share. As far as the domestic economy goes, our economy, Schwab noted that more than likely we're probably going to see a continued, as they refer to it, a K-shaped recovery, meaning that there are certain people and certain demographics in the economy that are doing well and others that aren't doing so well. And I think a lot of that is just a result of the wealth gap that's kind of ever expanding and increasing in the country. So you have some people that are really doing well despite the pandemic, and they're actually, some of them are even doing better. And then you have others that are really hurting. So I think we're probably going to see a lot more of that. At least that's kind of what Schwab anticipates over the next year or so, kind of this K-shaped recovery. Another interesting note was that the country's debt, the amount of money that we're borrowing, is increasing. And right now, at least as of this video, at least when I watched this video, the debt was rated around 100% of our economy, 100% of GDP, which obviously that's kind of a high amount, right? If you look back in history, you're going to see that the debt to GDP has really grown, and we haven't even talked about the $1.9 trillion stimulus package that is just about to be passed. So there's a concern there, obviously, that could lead to a massive rise in prices, right? A massive increase in inflation. Schwab did a good job, though, of pointing out some other economies that have experienced a lot of debt to GDP, like Japan, which I think if you look right now, Japan's debt to GDP is 200% roughly, depending on when you look at the data, 200% to GDP, and they haven't seen a lot of inflation in their economy. So I think that's kind of good to know, and doesn't necessarily mean we're not going to see inflation. Schwab thinks it's probably going to be more like an initial shock, or you're going to see some of these price increases or price shocks, these short-term spikes, whether it's in hotels and leisure or airlines. You're going to start to see certain parts of the market are going to just pop and prices are going to spike. But then as people start to get back into more of a normalized way of living, then that price increase should stabilize over time. But eventually I do think we'll probably see inflation. But as of right now, as it being a concern because of the amount of debt that we have, Schwab at least feels pretty comfortable in that we're not going to have this long sustained inflationary period, but rather some of these short-term pops. Question 3. What is your view on international versus domestic stocks and growth versus value stocks? So I'll just kind of stop right here and say this is no recommendation for myself or Schwab to buy or sell domestic or international or value or growth. This is merely their stance on those different asset classes and some of the key takeaways that I had from their response. So for the most part, a lot of banks are pretty conservative when they answer questions like this. They're not going to say, yeah, we're definitely in favor of buying growth stocks, or no, you need to sell value stocks right now. They're not going to necessarily take a stance like that. So Schwab seemed a little bit more kind of neutral on global stocks in general. If anything, they favored international bonds, specifically emerging market bonds, because they don't see that the risk associated with the relative yield is as high as it was once before. And let's take a step back, just looking at the emerging markets as a whole. China represents a large part of emerging markets. So given how well China and their economy has recovered, I think that's kind of one of the reasons why Schwab is looking at that component of fixed income and saying, hey, their yield is much higher than what you can get in the US, because the 10-year treasury is right around 1.4, 1.5%, where international bonds are significantly higher relative to the US. So they more or less just kind of talked a little bit about the bond market and saying that they are seeing more opportunity in international than they are in domestic bonds. They didn't really necessarily go into specific stock recommendations or specific asset classes or anything like that. They did highlight certain sectors that they think will perform well as rates begin to rise gradually. And one of those is financials. So banks obviously can make more money the higher the rates are, right? You take in money from depositors and you lend it out and you make your money on the spread. So as rates go up, banks obviously could benefit from that. In addition to that, healthcare was another sector that they said could perform relatively well for obvious reasons, right? You have a lot of money being invested into healthcare technologies and research and development and trying to combat some of these diseases and prevent another pandemic from doing what it did to us back in 2020. So they interestingly enough, they said that we as an economy could transition more from what we are now, which is more of a consumer spending economy, to more of an investment related economy as we start to invest in some of these technologies and improve our healthcare system. So I thought that was interesting, and something that probably is good to kind of keep an eye on is the way that our market shifts, if it does shift from being a consumer driven economy to more of an investment economy. Final question, question 4, and this is by far my favorite question because I get this all the time and I always reply with the same answer that Chief Investment Strategist Liz Ann Saunders responded with. So question 4, what should investors do with cash sitting on the sidelines? And this is the best answer you could possibly give to someone who asks you that question is, who's the investor, right? There are so many different types of investors out there, different risk profiles, different goals, different stations in life. There's so many different variables that it's impossible to give a blanket answer that says, hey, you should invest in emerging market debt with all of that cash that you have sitting on the sideline. So there's really no stock answer for what should you do with cash sitting on the sidelines. And Schwab kind of pointed out, you could have a single point of view on the market and the economy and have completely different advice for different investors, right? Because everyone is just so different. So one of the things that they did cite as a very important component of determining what you should do with this cash that you have on the sidelines is making sure that you're just being diversified in general, right? So spreading your risk out, stocks, bonds, alternatives, domestic, international, really spreading your investments out between different asset classes and making sure that you're rebalancing. They actually mentioned that it's probably a good idea to rebalance more often, especially as we start to see some volatility and some increased volatility in the market. Well, that wraps up the Schwab market summary for 2021. I really appreciate you taking the time to listen to the video today. If you're interested in keeping up to date with all that we are doing, please go to our website and subscribe to our blog at oneupfinancial.com/blog. Follow us on LinkedIn, follow us on Facebook, or wherever else you get your news. Thanks for watching, and we'll see you in the next one.